50,000 Kenya shillings monthly passive income is what Mr. John is getting today out of an investment of 1 million Kenya shillings that he did in January 2019, which has grown in a short span of 6 years to the current balance of 3 million Kenya shillings without Mr. John putting in any additional investment to this investment vehicle. Another person who invested 3 million shillings in January 2019 today is enjoying a passive income of 150,000 Kenya shillings every other month. A minimum investment amount of 250,000 done in January 2015 today is giving that investor 12,500 Kenya shillings passively, or better what we refer to as sleeping, without lifting a finger, and this investor did not top up any amount or any additional amount to this investment for the last short 6 years. We are talking about MANSA-X special fund, which has exhibited notoriety over the last 6 years by maintaining an average return of 17.8% throughout the period of 6 years that this fund has been in operation. John has to make either of two important decisions. The first decision is to switch on his passive income from this investment and continue enjoying that 50,000 Kenya shillings passively every other month. But John has a better decision, the second option, where John will allow this investment of 3 million today to stay in this account without touching it for the next short 4 years. At the end of the 4th year, John, through this simple decision of delaying gratification, of delaying consumption of the current passive income of 50,000 from this investment, and allowing this passive income to continue compounding in the investment for another 4 years, such a short period of time, and that decision will yield a stepped up income, a stepped up passive income, or that decision will expand John's monthly passive income, actually doubling it to a new high of 90,000 Kenya shillings by waiting for 4 years. This second investor who did 3 million and today is enjoying 150,000 worth of passive income because the amount they invested in January 2019 has tripled to 9 million Kenya shillings. Today is the current balance in the account. If this investor allowed the account to compound for another 4 years, that passive income will switch from 150,000 monthly to a new high of 270,000 Kenya shillings every other month while this investor is sleeping. We have our investor who did the minimum accepted investment for this particular fund of 250,000 in 2019, which tripled to 750,000 today. And that investment is giving this investor 12,500 every month passively. If this investor allow this money to compound for the next 4 years, just 4 years, the amount of capital balance will have doubled to 1.5 million by 2029. And that time, these investors' passive income will double from 12,500 monthly passive income to a new high of 22,500 monthly passive income. That could be you. The idea on compounding and doubling is based on 72 rule, where this rule we use it to determine the number of months, number of years, or the period it will take for a specific investment vehicle to double the amount of capital that you have invested in that account. We have two ways. We have an investment platform or an opportunity that gives you a fixed return over time, a given period of time. In such an example, to determine the period that it will take that investment to double your investment, then you take 72 divide by rate of return. For example, if you're investing £1,000,000 in an investment platform that is going to give you a return of 18% fixed or each year, then it will take you 4 years to double that amount, or for your account balance to read 2 million. That is 72 divided by 18 is going to give you 4, where 4, that is the number of years it will take for this investment to grow from 1 million to 2 million. In the event of an investment opportunity that is giving you varying returns, then the value to use will be the average performance of that product for a given period of time. In this case, we are looking at 1 year this vehicle is giving you a 15%, another time it has given you 20%, there is another year the return was 17%, 18%. You determine the average, and that is the average is what you are using to divide 72 to get the number of years it will take you for this investment with a varying return to compound or double your investment. We always have a disclaimer when it comes to investments, and the disclaimer is that past performance is not a guarantee of future performance. But the only way you can evaluate an investment product is by using its performance in the past. We shall be looking at the risk categorization, the performance analysis, the fund details, and what you need to onboard on this particular product after 3 seconds short break, so don't go away. In the meantime, as always, give a like to this video, engage us in the comment section, and if you are new to the channel, don't forget to subscribe and hit the notification button, because if you do that, YouTube will be sending you a notification when we upload our next value-packed video. See you after 3 seconds short break. Welcome back, and the first thing that we are going to consider is the risk categorization of these funds. As per this small schedule, which we have extracted from the fund fact sheets of MANSA-X special fund, it's clear that this fund is categorized as a low risk investment fund. Money market funds that we are used to are categorized as low risk, and as per this profile, money market funds are placed under category number 1. This special fund being placed under category 2 does not mean that it has or it bears double the risk in a money market fund. No. The categorization number 1 and 2, they are not distant apart. Looking at MANSA-X fund objective, or the reason why this fund exists, you realize as per this statement that the primary objective, the main objective of these funds is to offer above market average returns, with the reason to accelerate the growth of client capital. And this is achieved mainly through diversification. So diversification is a very important matrix in the performance of MANSA-X special fund. The sole aim of this fund is to ensure that the fund manager does everything possible to ensure that the fund will deliver above market alpha returns, which are aimed at ensuring that the client capital growth is accelerated, and that is achieved through heavy diversification of these investments. It's important now we look at the levels of diversification, or the extent of that scope. And the first important thing to look at is the asset classes that this fund manager exposes our investment to and the extent to which the asset manager is able to actively manage the assets under investment. And looking at this schedule of asset classes, this fund focuses mainly on global markets and invests in the following asset classes, which have been divided into two. We have the global asset classes and the local asset classes. In the global segment, the fund manager has access to single stocks and stock indices. He has access to fixed income securities, derivatives, precious metals, currencies, and commodities. In the local financial markets, there are cash and cash equivalents, there are fixed incomes, we have NSE, derivatives, exchange traded funds, and NSE equities. We can also look at the export or the level of distribution in terms of specific global markets. And as per this schedule, which outlines the fund asset allocations to different markets as at the end of the first quarter in 2025, the American markets have over 40% of the assets under management in this fund. Europe markets holds 33.48%, African markets holding close to 20% at 19.20%. Then we have Middle East and Asian markets that are holding 5.95%, while Oceania has 1.03%. That gives you the extent of diversification or spread of the assets under management to different markets. Further to diversification, it's also important we look at the specific assets in these markets and under the asset classes, the extent to which specific assets have been invested into, and that we are looking at the top 10 investments and the percentage that has been invested to these particular assets. And as per this schedule, number one, we have fixed income instruments, which have taken about 15%, standing at 14.62%. Interest rate derivatives are holding only 5.34%. Volatility SP500 index is holding 3.83%. Canadian dollar holds 2.91%. High share MSCI China electronically traded fund holds 2.69%. Cash and cash equivalents are holding 2.55%. Best Buy is holding 1.47%. We have BAE Systems holding 1.4%. United Parcel Services holding 1.38%. And Gilead Sciences holding 1.36%. If you take a sum of these percentage allocation to the top 10 asset holdings, you realize that these holds a paltry 35.6% of the entire asset under management. That is to signify the extent of spread of the assets under management to different assets for investment. And that is the extent that diversification has been applied as an important matrix in investment for this particular special fund to realize the alpha returns while actively minimizing or keeping the risks at the lowest level. The next important item to look at will be the performance. While the holding of the disclaimer that past performance does not guarantee future performance, that is the only way you can evaluate an investment opportunity. And as per this schedule depicting the performance of this fund from its inception, that is in January 2019, this curve shows extensive growth through compounding and accelerated growth of investor capital. And a good example that has been used is an investor who deposited £1,000,000 in 2019 January. Today, by close of the first quarter in 2025, that is 6 years down the line, that investor capital has tripled to 2.94 million shillings. And this is because of what we shall be looking in the next schedule of performance over those 6 years. We'll be looking at the performance each year and drawing an average performance of the fund throughout the 6 years. It's important to note that this nature of investment suits your long-term goals, your long-term investing. And therefore, for this investor who invested £1,000,000 in January 2019 and has allowed that investment to compound for the last 6 years, today that amount 6 years down the line has tripled. And if you were to calculate what would be the monthly passive income for this investor out of this fund at the average rate, then this is an investor who is enjoying 50,000 passive monthly income. And this is the investor that we have analyzed that if this person was to allow this investment to continue that compounding for the next 4 years, the amount that reads in the account today, which is 3 million, will double in 4 years to 6 million. And the rationale is that if you apply the rule to the performance of this average performance of the fund, which is about 18%, your investment is supposed to double after every 4 years. And that would effectively step up the monthly passive income of this investor from the 50,000 monthly passive income to a new high of 90,000 monthly passive income. To evaluate the performance of this fund, we will first look at the 12-month performance for the last 6 years since the fund inception. As per this schedule, this fund started in January 2019. In the year 2019, the fund performed at a gross return of 24.01. Gross return is the total return including the fund management fee. This fund is charging a management fee of 5%. Because the management fee and the actual return, they are based on the same object, which is the amount invested. To get the net return, you just get the gross return minus the fund management fee of 5%. So in 2019, if you take that 24.01 minus 5, then that left the investors with a net return of 19.01%. Considering that this fund has an hurdle rate, an hurdle rate is a target performance by the fund manager. In all the efforts and activities of the fund manager in his diversification of this fund, he aims to generate alpha returns to the investors, and the fund manager places a target for himself of 25% performance. So in 2019, this fund manager came too close to the hurdle rate, which is the target performance of 25%. In 2020, which was the second year of performance, the fund generated a gross return of 23.75%, and that translated to a net return of 18.759%. The third year of performance in 2021, the fund generated a 23.75 gross, leaving a 15.45 net return to the investors. 2022, the fund generated a gross performance of 20.45, leaving us investors with a net return of 15.59%. 2020, this period is very significant to the investor in performance evaluation, considering the fact that this was during the global disaster of COVID-19, when most businesses got affected, most fund managers got affected, and the returns during this time were quite low. But this fund survived all those economic challenges and still managed to give the investors averagely half returns during a difficult economic time. In 2023, the fund generated a gross return of 23.01%, leaving investors with a net return of 18.01%. And 2024, which is a year that most of the investment vehicles or investment solutions performed quite very well. If you look across all the investment vehicles, in 2024, this fund generated a gross return of 24.53%, which was the closest to the hurdle rate or the target rate for the fund manager, which is 25%, and that left the investors with a net return of 19.53%. If you take an average of performance, the net performance for those years that this fund has been in operation, if you take the 19%, the 18%, 15%, the 18% and 19% net performance for each year, take a sum of them and get an average return performance for this fund, you are getting an average of 17.89%. Loosely translating to about 18%, which I've been using in my examples for ease of calculation. And looking at the performance in the market, that is ideally a good performance. Further to the analysis of the 12-month performance of the fund since inception, we can look at the quarterly performance of this fund for the last 2 years. And this schedule, we are looking at the quarterly performance for year 2023 and 2024, inclusive of our first quarter 2025, which is our period under consideration. And the yellow line that is running horizontally, that is the line that is giving us the average quarterly performance. Since inception, an average quarterly performance for this fund has been a 4.45%. Quarterly performance, that this includes a performance for each month consisting a quarter, then taking the average of the 3 months. If you annualize this quarterly performance, if you recalculate it to what it translates into a performance of 12 months, which is a year, which is now what we are calling annualization. This one you multiply by 4 because it's a performance of 3 months translating to a quarter. So if you multiply 4.5% multiply by 4, that is where you are getting the 17.8%. Looking at the individual quarterly performance for the last 2 years, comparatively, our Q1 in 2025, if you compare with Q1 performance in 2024, the performance was 5.62%. In our Q1 in 2025, the performance has slightly dropped to 4.89%. If you take that 4.89, which is the actual Q1 performance for 2025, and you want to project what would be the performance for the whole year, that is annualization. To annualize this actual Q1 performance, you multiply by 4, and that will give you 19.56%. The 4.89, that 19.5% is a net return. And because the performance of this special fund charges a management fee of 5%, if you calculate to get the gross performance annualized return, you will get your 24.56%. The next, we are looking at the fund specific details and what you need to onboard to invest in this special fund. That will come after 3 seconds short break, so don't go away. One important element that is always frowned upon is one of the reasons for averagely low performance or reduced performance is the fund size or the total assets under management for a particular fund manager. If you take into consideration this schedule, and this is the Capital Markets Authority, that is the market regulator report on the fund sizes or the market share of different fund managers. And you highlight that and you notice that MANSA-X Special Fund is the third largest fund manager by fund size as at the close of the year 2024. By the close of the second quarter, which was September 2024, MANSA was holding 34.2 billion worth of investor funds as the asset under management. By the close of the fourth quarter, by close of December 2024, that asset under management grew from 34.2 billion to 41.6 billion. The growth is not the most important thing that we are looking for, but we are looking at the fund size. 41.6 billion fund size. That is a huge fund considering the number one market, considering the highest fund size in the market is at 82.4 billion, followed by 62.7 billion. But still, those funds are performing or are giving us a return that is way lower than what MANSA-X Special Fund is. And one of the main reason is that MANSA-X is a special fund, while these other two are traditional funds limited in terms of scope or number of asset classes that the funds are exposed to, or the level of diversification. So the traditional funds have a smaller scope in terms of diversification compared to the special fund, that is in particular MANSA-X Special Fund. If you look at the performance of the fund size at the close of Q1 of 2025, this fund size grew from the 41.6 billion to a new 47.29 billion. So even as the fund is growing at that fast rate, the fund manager has continued churning alpha returns through this investment solution. Compare with the other special fund, compare with other coming up special funds which are managing a smaller fund size. The performance of MANSA-X Special Fund is way higher averagely considering the size of the fund under management. Then looking at the general fund details or the fund overview, MANSA-X Special Fund began in January 2019. The total assets under management to date, that is at the end of March 2025, which is the close of the first quarter of 2025, stands at 47.29 billion. Quarter is very important in the fund analysis of MANSA Special Fund. This fund compounds your investment on a quarterly basis, not daily or monthly. It compounds the returns on a quarterly basis, and that also means that the fund manager communicates or issues statements of your account every other quarter. Any statement issued in between a quarter will not reflect the changes because the fund has to close for calculations at the end of every quarter for generation of updated statements. The base currency is Kenya shillings for this particular fund, but you'll notice that because the fund targets global financial markets, the investments will be in different currencies for the respective markets where those investments have been done. But for purposes of distribution of the incomes or distribution of returns to the investors, that is done using our local currency, that is Kenya shillings. And that what it means, that can give you an idea of the nature of some of the risk exposures, including that currency risk, market risk, leverage risk, hedging risks, liquidity risks, and all those risks are mitigated actively by the fund manager and primarily through diversification. The minimum investment, the minimum amount that you are required to invest in this particular fund for your first investment is 250,000 Kenya shillings, while any other time you want to do a top-up, you are required to deposit a minimum of 100,000 shillings. This fund will not charge you any redemption fees or liquidation fees. When you want to access this fund, you will not be charged a fee for that access or liquidation, what we are now calling redemption charges. But remember, this fund has a mandatory locking period of 6 months. Your first investment will not be accessible by you for the first 6 months. But after the close of the 6 months, then that you will be able to access those funds anytime you need them. The financial charges, or what we commonly call the management fees for this particular fund, are at 5% per annum prorated. Someone might ask why these fund charges a higher rate of management fees compared to the traditional collective investment schemes, the money market funds, the fixed income funds. And majorly, this fund requires more resources, a lot more inputs for it to perform at those levels of diversification. And that is one of the key reasons why it requires a higher fee compared to the other funds. And also, special funds would require more skilled labor in their management or to run especially the trading for these particular funds compared to the traditional ones. A performance charge. But before we look at the performance charge, we have to look at the fact that this fund has a target performance which has been set by the fund manager. The fund manager actively is assigning assets or is assigning funds to different assets and actively managing them, looking at a high rate of return, which he has set himself a target of 25%. And we are seeing how close he came to 25% performance in 2024 and 2019. In the case the fund manager achieved his target performance of 25%, all that performance which will leave a 20% return, net return to the investor, that goes to investor. But upon surpassing the performance, because over that target, which we are calling the hurdle rate, if the fund manager exceed that performance, the extra or the performance above 25%, if it's 27%, we are talking of 2%. That extra performance, it will be shared between the fund manager and the investors. The fund manager taking a small percentage, just 10%. So the extra performance above the hurdle rate or the target performance still goes to the investors to a tune of 90%. So the performance fee of 10% does not apply every year on the returns that apply. It only applies in that particular year where the fund manager exceeds the target performance of 25%, and it will be applied on the extra performance above 25%. Then important, we look at the fund ecosystem or the service providers in this particular fund. The fund manager is the Standard Investment Bank. Standard Investment Bank was started or incorporated in the year 1995, and that gives you a fund manager with 3 decades of relevant experience in investment and crafting solutions for investors. The trustees or the prefect for this particular fund, the person who ensures that the investor interests are put first, is Kingston Land Court Trustees. Then we have the regulator, the security for the investors. This fund is regulated. The fund manager is also regulated by Capital Markets Authority, and the custodians, the persons who are holding the investor money in trust, because the fund manager never comes into direct contact with the investor money, and that is the tripartite organization of this investor ecosystem that guarantees security for investor funds. The custodian here is I&M Bank, and the auditor is Charterfy LLP. In terms of protection of investors, generally, which is exercised by the Capital Markets Authority. The fund ecosystem is arranged in a manner that it brings in three parties with segregated functions, where the three parties running specific function of the fund ensure the security around the investor. If you are looking forward to investing in MANSA Special Fund, these are the documents that you would require. One is a copy of your ID. The second one is a copy of your KRA PIN. Then the third one is a copy of the front part or the face of your ATM card. Never share the details at the back of your ATM card. What is required is just a copy of the face of the ATM card that shows your name and the account number. The rest of the details at the back of your card, those are private security details for your account. Never share the details at the back of your card. Then number 4, you will need a colored passport photo. And the fifth one is it fields account opening forms that will be shared to you upon request. If you need to join MANSA-X Special Fund, kindly reach out through WhatsApp or my email that you get from the channel description. Thank you for watching and see you in our next video.